Welcome to Business with Teacher T. In this video, we're going to be looking at internal sources of finance. Here are some reasons why a business may need finance. The business may be a startup business and need the finance to pay for the building where the business will be located. It may need to pay for machinery in the business and other fixtures and fittings, as well as advertising the business. An established business may also want finance to expand. The finance could be used to open up new stores and, in general, to set it up. Finally, a business may want a source of finance to pay for the day-to-day expenses a business might have, which includes paying employees' wages. There are a range of sources of finance that a business could consider. However, not all are suitable for the business. Here are some examples of both internal and external sources of finance. The money could come from personal savings. It could come from an overdraft, family and friends, sale of assets, a loan, crowdfunding, retained profits. There needs to be a consideration of whether the source of finance is appropriate for the business, how quickly it's needed, whether they'll be approved, whether or not they'll be left with high interest payments. So there's lots of factors to consider when deciding on a source of finance. The finance that a business chooses needs to be matched with the short, medium, and long-term needs of the business. Short-term sources of finance may sometimes be used by businesses to pay bills and deal with any cash flow problems. Medium-term sources of finance may be needed for more than 1 year and less than 5, and could be used to purchase expensive equipment, fund a new product line, or even expand. Long-term sources of finance can be used by businesses for a range of things, such as to finance long-term plans, like purchasing land and buildings. Internal sources of finance are funds that come from within a business, such as retained profits, whereas external sources of finance are funds that come from outside the business, such as a bank loan. The three types of internal sources of finance that we'll be looking at in this video are personal savings, retained profits, and sale of assets. Personal savings are the business owner's actual savings that they have. They may have acquired this from redundancy, inheritance, or even a lottery win. This is a typical internal source of finance for a startup business, and it shows a high level of commitment from the business owner to be investing their own personal savings into the business. Let's look at the advantages and disadvantages of businesses using personal savings as a source of finance. One advantage is that there is easy access to funds. The business owner doesn't have to fill out an application form and wait for a decision. They already have access to their personal savings, so therefore they can readily purchase what they need to or use the money to pay day-to-day expenses or whatever they're going to do with the money. Another advantage is that no interest payments are required on using the personal savings. It is their own money that's being used. However, a disadvantage of using personal savings is that a business owner could lose all of their savings. Perhaps this was money that was saved for another purpose, and now the business owner needs to use it to pay for day-to-day expenses. If that's the case, then all of their personal savings may be lost. Retained profit is the profit after all costs and dividends to shareholders have been paid. This source of finance is important and can only be used for established businesses making a profit. It cannot be used for startups as they would not have been set up in business, so they can't access any profit. This internal source of finance is cheap, and it is a good source of finance to be used if a business is interested in expanding and opening new stores in new locations. Before we start looking at the advantages and disadvantages of retained profits, let's have a reminder or introduction to Carrie, the owner of a construction firm. Now, you may have seen Carrie from a previous Teacher T video, as she is a sole trader. Retained profit is based on historical profit being made from previous trading years. So if last year Carrie, the construction company owner, made a profit of £50,000 and the year before she made a profit of £45,000, then in total she has £95,000 of retained profit that she could access. Let's start to look at the advantages and disadvantages of retained profit. One of the advantages is that there are no interest payments required. So a loan hasn't been taken out, so they don't have to pay any interest at all. It is the profit that has been made from previous years, so it's already theirs. Another advantage is that firms can access the retained profits easily. So if it was a case of Carrie wanting to access this £95,000, one would presume that's saved in a bank. Easy access. However, once the retained profits have been used, they cannot be given to the owners or shareholders, so that's a disadvantage. Another disadvantage is that the amount that a business has in retained profit may be insufficient. So if Carrie has a project, for example, that costs £120,000 and she only has £95,000, then that's going to be insufficient in order to conduct and complete that project. Businesses can raise finance by selling unwanted assets. Selling some assets can raise large amounts of cash for businesses. Selling assets is an opportunity to raise money fast for business owners. A business can sell unwanted assets such as machinery, buildings, land, delivery vans, and it's a way to raise capital for an established business. This is also a long-term source of finance. Let's start by looking at some of the advantages of sale of assets. Businesses are able to raise large amounts of cash. Selling unwanted assets such as unwanted machinery. This can bring in extra money to a business to pay towards expenses or even to buy new equipment. Another advantage is the ability of a firm to raise money quickly by selling assets. This is often dependent on the type of asset sold. So if a business were to sell unused equipment or vehicles, these type of assets may sell quickly and can be used to improve the business's cash flow. However, there are disadvantages to selling assets. A business may end up selling assets that they could have benefited from having. For example, a business may sell one of their delivery vans thinking that they may not need it, and then there's an upturn in customers demanding their goods, and they no longer have sufficient delivery vans to deliver these goods. Another disadvantage is that a business may find selling some assets such as land and buildings quite challenging. Some of these assets may take time to sell, and in the meantime, the business may be in need of the cash quite urgently. Thanks for watching this video on internal sources of finance. There are some Teacher T external source of finance videos as well. Just a reminder, don't forget to subscribe if you're liking this business vibe. See you later.